Hey there, it's Ben from patternprofits.net. I wanted to bring you a quick video on moving average clouds, and I'm going to tie in with this how to hang on to a winner and stay in it a little longer for a bigger gain. So first, with the moving average clouds, I get asked quite a bit lately, what's that green and red on your charts? And basically, this is the same moving averages you've been using and been seeing for years and years, just in a cloud format, so it's a little more subtle in the background. So if I was to come over here and put the actual moving average lines like you're used to seeing on the chart, this short one in red, this is your 10-day moving average. This here, this is your 20-day moving average. You're used to seeing these. You're just not used to seeing the area between the 10-day moving average and the 20-day moving average and simple moving average in this case, but you can use EMA too. But you're just not used to seeing it filled in green or filled in red. This area down here would be the 50-day moving average on the daily chart. So same moving averages you're familiar with, the 10, the 20, the 50 down here, just in a cloud appearance, which is a little bit more subtle. So what I also want to do is take you over to a weekly chart, and we're looking at Peloton here. And one of the other things I've been getting asked quite a bit about lately is, how can I hold on to a winner for longer? So if you bought out of this base back here, breakout here over in the low 30s, let's say you came in here, bought the breakout, this little cloud that I have on here, this is a 10-week moving average at the top and a 13-week moving average at the bottom. So that's basically giving you the 50-day moving average and the 65 moving average in a little cloud appearance. So if we were to zoom in on this and you bought it back here, this should have been, for most, a relatively easy ride on the way up to hold on to. Here's a little trick that helps. If you take some profits, let's say you got your 20% in. So basically, if you came in at 30 or 31, 32, you're selling at 20% around 36, 38, somewhere in here, took profits, pulls back. At this point, when your cost basis gets above the 10-week moving average, at that point, what I like to do, if I've already taken some off especially, is switch over to the weekly chart. I pay very little attention to what's going on the daily chart, because that noise will create emotions and you'll end up, exiting early. So if you want to hold for this type of move, I highly recommend, as soon as your cost basis is below the weekly 10 MA or the 50-day moving average, however you want to look at it, once your cost basis is below that, switch over to the weekly chart, pay no attention to the daily chart, and then all the way up, this was relatively easy hold. Um, the reason I say relatively is because there's a lot of noise and drama on FinTwit. Everybody's telling you it's a short, and COVID and vaccines, and everybody's going back to the gym and blah, blah, blah. Price action said otherwise. So as this is working its way up, you really only need to look and check it, on Fridays. What's it doing on Friday? How does it look at the end of the week all the way up? So where we did start to see things kind of change was here. And on this week, did break below the 10-week moving average, but I did not get shaken out. And the reason I didn't get shaken out, it was a strong close to the week. It closed just barely under the 50-day moving average, or the weekly 10 MA, let's say. And if maybe you create a rule where it has to close 2 or 3% under that, or you have to see significantly above average volume. There are a bunch of little nuances to getting out of this on a weekly close under the 10-week moving average. But a few of the rules that I really like to pay attention to. Big volume. If I saw volume bigger than this over here, maybe that's a sign to go ahead and exit. If it closed in the bottom of the range down here, a clear break, no sign of institutions coming back in to support it, maybe I also exit. I'll tell you another trick. You take these 2 weeks below the weekly 10 MA, take that low. If the low of those 2 weeks, which in this case is 92.03, if the low of those 2 weeks gets taken out, that's also an exit signal. If it drifts sideways and doesn't quickly reclaim the weekly 10 MA, that's another exit signal. So you need to put rules together that fit your approach and tells you when to get out. But in this case, none of my rules that I have for getting out of this came through. So I did not get shaken out of this. In fact, as soon as it reclaimed the 10-week moving average and got back above anchored VWAP off the highs, I came back in and added to my position. So I'm long from 31, and then I added another about 20%, up over 104, I believe it was. My cost base is still about 46. So this is a trick that you can use. Don't let this shake you out. You've got to really pay attention to how it closes in the week. If it closes in the upper part of the range, that's a sign of support, even though it may have dipped below the moving averages earlier in the week. A lot of times, the 2-week rule, where you use the low of 2 weeks below the 10-week moving average, that can help you. If that gets taken out, you exit. But a lot of times, especially if it's a really strong stock, you don't want to try to do this with all the stocks in your portfolio. You want to do this with the best performing stocks, strong fundamentals, and a new product or service that's changing the way we work, live, or play. Those are the ones that you want to focus on. And if you have a nice cushion, switch over to the weekly chart, and hopefully that can help you ride it to a much bigger gain. Thank you.